Since depreciation represents the usage of the asset, in case the company buys the asset in the middle of the year, then the depreciation will need to be computed for that partial year. So in this case, suppose UPS purchased a warehouse building for $500,000 on April 1 for 20, and this useful life is 20 years with a residual value of $80,000. The accounting year ends on December 31st. So you'll need to, in this case, compute the depreciation from April through December. So you can compute the full year depreciation, which is the cost, 500,000 minus 80,000, divide by its useful life. So the depreciation, if it was purchased in January, would have been 21,000. However, since it's purchased in April, the depreciation from April 1st to December 31st for 9 months will be 21,000 times 9 over 12, which will give you $15,750. So after the asset, or during the period, if you change the useful life of a depreciable asset, then you will need to make certain adjustments. Please note, when you make the adjustment in the change in the useful life of the asset, the accounting will be done in the future periods, so the changes will be made for the future periods. Prior periods will not be adjusted, and it will just be called a change in estimates. For example, you've got equipment that was purchased for $510,000 with an estimated useful life of 10 years with a residual value of 10,000 at the end of the time. Suppose the depreciation has been recorded for 7 years straight on a straight line basis in 2004. And in 2014, that is year 8, the Arcadia determines that the useful life is not 10 years but 15 years with a residual value of $5,000 at the end of that time. So how do we deal with this change in the estimate? As far as to correct any prior year's depreciation, no entry is required. We do not make any adjustment to the prior year. Then what we do is we calculate the depreciation for the current year. So equipment cost originally was $510,000. Depreciable base was $500,000. So the 7-year straight line depreciation was 50,000 times 7 for $350,000. Net book value as on December 31st, 2013 is therefore $160,000. Now at this point of time, the depreciable life of the asset has been changed to 15 years. So as far as 15 years, 7 years have been already expensed, so remaining years are 8 years. The depreciable book value today is $160,000 less the residual value, which is $5,000 now estimated again, and the remaining life of the asset is 8 years. So $155,000 will be written off over 8 years to get you the annual depreciation of $19,375. Entry, as far as entry is concerned, you debit the depreciation expense and credit the accumulated depreciation expense. That part more or less remains same. So when the asset is fully depreciated, your book value will be 0 because your equipment is at 60,000 and your accumulated depreciation is at 60,000 and book value is at 0. Now, you might continue to use the equipment for several more years, but you will not be able to charge the depreciation when the book value comes down to 0. And in case, if we want to sell off the plant and the asset, how do we measure this, or how do we account for that sale of the asset? We know what the book value of the asset is, and when we sell the asset, we remove the asset as well as the related accumulated depreciation account from the books. We also record the depreciation expense up to the date of sale of the book. We also estimate the final book value for sale. Let's take an example where you got a fully depreciated assets and you are just disposing it off. So you've got a machine that costs $60,000 with an estimated zero residual value. The machine's accumulated depreciation totals $60,000. So your cost of the asset and your accumulated depreciation is same. In this case, if we dispose of the asset, then you close the related accumulated depreciation account by debiting it, and then credit the machinery account by $60,000. So both the items are closed. Now, if you are disposing of the fully depreciated asset again, for which has a book value, so in this case, for example, you dispose of an asset that costs $60,000 with an accumulated depreciation of $50,000. Therefore, the book value is $10,000. If you junk this equipment, then you, for all purposes, will record a loss on sale of that asset, because the accumulated depreciation account for $50,000 is closed, and then the related loss on disposal of equipment is $10,000. Similarly, since $60,000 has been accounted for, your equipment account will be credited and the balance will be $60,000, will be zero in the equipment account. And the gain or loss on disposal of equipment is then reported as other income or expense in the income statement. So whenever you're selling a plant asset and you get money greater than the book value of the asset, that is cost less accumulated depreciation, you have a gain. In the opposite situation, when you have received the cash which is less than the book value of the asset, you have got a loss that needs to be recorded. Let's take an example of selling a plant asset. Suppose an equipment has been bought by FedEx on September 30th, 2014 for $7,300 cash. It sells the equipment for $7,300 cash, so it has received $7,300 on September 30th. Equipment costed $10,000 and was purchased in 2011, has been depreciated based upon straight line method. Estimated useful life was 10 years. So first of all, since it was sold in September 30th, and you need to also record the depreciation for that period. So partial depreciation must be recorded for the asset from January 1 to September 30th. So your depreciation expense on a straight line basis, which was $10,000 divided by 10 years, or $1,000 a year, 9 by 12th of that 1,000 gives you $750 for the depreciation expense for the period. Once you have got the depreciation expense for the period, then you compute the book value of the asset. So cash that has been received is $7,300. The cost of the asset is $10,000. Your accumulated depreciation from 2011, 2012, 2013, and 2014 is total of $3,750, $1,000 every year, and $750 for the partial year in which the asset has been sold. It gives you the book value of $6,250. Since you sold the asset for $7,300, which is higher than the book value of $6,250, you have got a gain of $1,050. So now we need to record this gain in the books. So first of all, we know that we got the cash for $7,300. We know that the related accumulated depreciation account for $3,750 will be closed. Since the asset is sold off, your equipment has been credited by $10,000. And then the balancing number is your gain on sale of equipment of $1,050. Thank you very much for listening to the presentation. Have a nice day.